The IPO market is very sentiment-driven, very momentum-driven. It's a high alpha type of product. So when there is a market that is skewed toward growth and investment, it tends to favor IPO for sure. When the market becomes more volatile or risk-adverse, the IPOs are the ones that get a bit more challenging to execute.
So is it just me, or have we been talking about tariffs for like 30 episodes at this point?
Yes. No, it's not you. Yeah, we have. I think it's in the headline of like half of our episodes. But I will say we always talk about tariffs in like a very like obviously from the market's point of view, the macroeconomy and things like that. We don't talk too much about like what it means for like day-to-day people. Obviously, will it be felt in prices? And we've seen it here and there and things like that. But something happened the other day that I thought was interesting, just in my personal life, which is that I was talking to somebody who was like buying some furniture, and they said we got a call one day from some shipping authority or port, and they were like, hey, your thing is here, like, please pay the tariff. And they were like, what? And they were like, well, somebody's got to pay this tariff because as of today, because tariffs have sort of gone into effect, but sort of not.
Sure.
Obviously, that's one thing that people have been discussing. And I guess apparently somebody thought that they owed a tariff on this. Now, they worked it out with the company sort of that they were buying it through. But, these are the first people that, who weren't like trade lawyers, who weren't running some importing, exporting businesses. I knew that was like here directly is like, you need to pay a tariff today. That was the first time that it happened to somebody that I knew.
I got a call from my mom saying something similar, that some piece of furniture was crazy delayed, and she said it was because of tariffs. We're going to dive into this a little bit more, but before that, let's introduce ourselves. I'm Gunjan Banerjee, and this is the Wall Street Journal's Take on the Week.
And I'm Telis Demos. And yeah, let's talk. We've got a few other things we want to talk about. We want to talk about banks. We want to talk about the IPO market. We're going to have a really big conversation about that. But let's just talk about what happened with tariffs this past week, because obviously it's theoretically big market news, though maybe not. The new deadline is going to be August 1st for the reciprocal tariffs. It's been moved around. It's been pushed around. But Trump says he's serious this time. No extensions. August 1st deadline. To get there, he sent around some letters. Japan, South Korea got letters telling them that they were going to have a 25% rate. Some other countries got some news. Actually, okay, this one's kind of interesting. Brazil got a 50% tariff.
Okay.
And the reason cited, or one of the reasons cited, was because of the way that they had treated their former president, who's sort of a Trump-like figure in the country. So
interesting.
Yeah, not purely for economic reasons. So adding a political, sort of diplomatic element to the tariffs, which normally I would think would spook the market. But has it, Gunjan?
I mean, it's crazy. The S&P 500 is up around 25% from its 2025 closing low, hit in April. I mean, remember that market madness that lasted a few weeks? But now we're back at highs.
I barely remember that market madness. It seems like 1,000 years ago.
It out. I mean, I think a lot of this is due to the AI trade just roaring back. It's due to NVIDIA, which is now a $4 trillion company. It's back at a record. I saw a really crazy stat out there, which is that NVIDIA is now worth as much as the 214 smallest companies in the S&P 500 combined. So it's worth as much as like half of the S&P 500 at this point.
Just one company.
And I think this is part of why we're not seeing tariff fears reflected in the stock market, right? And I'm curious if you think we'll see banks sounding a little bit more alarm about this next week. I know you've been writing about this.
Yeah. I think we've got bank earnings kicking off this coming week. The biggies, JP Morgan Chase, Wells Fargo, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, America's big banks will be reporting. And I don't think that those big banks are going to necessarily be feeling it that much. Now, I will say that the large bank stocks have pretty dramatically outperformed, and this is something I'm going to be writing about, as we head into earnings this upcoming week. The small bank stocks have pretty dramatically underperformed, and I think that's because of what we're seeing in loan growth. When you look at commercial and industrial loan demand, it's not really growing. There was a bit of a pickup when companies kind of drew down on their credit lines. That means that they kind of like borrowed a little extra cash, little walking around money, just for everything going on, as we like to say. But we're not seeing yet a really big pickup in C&I, as we call it, loan growth from the banks. And, maybe that reflects the fact that people still aren't making kind of like big investments in, reshoring or whatever we think that might come out of the other side of tariffs. Now that we're through the budget, look, obviously, there's some concerns about the deficit element here. We've seen what's happening with the dollar and the treasuries market. But, from a U.S. economy point of view, big tax cuts coming through, that might be good for the economy, good for businesses. So the bank's commentary, I think, will play into that as well.
And what they say about the U.S. consumer, right? Are people still spending?
Absolutely. They're the big banks are also the big credit card companies, and we'll see if people are still flashing the plastic and also paying it back after they flash it.
Flashing the plastic.
But another thing that I think is kind of market opening up those animal spirits in the market is what's going on in crypto. And in the U.S. House is planning to have Crypto Week this upcoming week. So the Senate passed the Genius Act, which is going to regulate stablecoins. The House hasn't taken it up yet. But what do you think, Gunjan? What do you think that the bullish spirit around crypto kind of bleeds through to the rest of the market?
It feels like animal spirits are back, right? Companies that don't even have profits have been doing really well in this environment. Crypto has been on a tear. Robinhood stock, as we chatted about recently, has done so well this year. It's up more than 100% this year. And I think it got another boost recently, right? When it said that it was going to offer these tokenized stocks and give people the opportunity to purchase stakes in private companies, like AI companies and a few others out there. So, I think animal spirits are just back in a big way. And this is one example of that. It's been really interesting to see just the desire for gambling in financial markets this year at a time when we have seen some of the biggest swings for the stock market, really, of the past decade. Like, people are still trading options. People are still trading stocks. Maybe they might buy into these tokenized stocks or trade in the prediction market. So that's been really good for businesses like Robinhood.
Well, and I've got news for you on one of the oldest forms of sort of market gambling. The IPO market is kind of coming back this year.
Oh, finally.
Finally.
I feel like people have been saying that for a while.
Well, so obviously 2021 was a ludicrous year. There were almost 400 U.S. IPOs that year, thereabouts. And this year, through very recently, we've got, about 100. And so if you project that out for the rest of the year, that's 200 IPO year for the U.S., which would put it as really one of the better years, not just it would be the best year since 2021, but also just one of the better years of the past decade in terms of the number of deals.
Well, are we seeing those big one-day pops that we've seen in the past?
Yes, IPO pops. There have been some of those. Circle, the stablecoin company, obviously with everything going on with the Genius Act on Capitol Hill, people are pretty excited about stablecoins. So Circle has been a bit of a rocket ship. And I get into what's going on in the IPO market with Arnaud Blanchard. He is the global head of equity capital markets at Morgan Stanley. Morgan Stanley is a bank that does a lot of IPOs. So it's a really interesting conversation, and we're going to have that after the break. So this year, we're having a bit of kind of a comeback for the IPO, particularly in the U.S. And so, Arnaud Blanchard, you're the global head of equity capital markets at Morgan Stanley. Morgan Stanley seems like it's always in or around all of the big IPOs. Certainly, it's a name that's come up for probably every IPO that you can name or remember over the last several years. Morgan Stanley's been around it. So what's happening this year? Is the IPO market back, would you say?
I think it's definitely coming back. And there are a few parameters I look at to assess the health of the IPO market. And I think as the macro environment changed in 2022, it became a much slower year for IPOs.
What was the thing that changed? Why did that?
Fed policy change in
interest
valuation,
rates were higher.
interest rates, stock prices being much more depressed post-COVID.
Okay.
So I think it led to a year in 2022 where we had, I think, 20 IPOs, which was very low. The following year, 2023, 30 IPOs. Since 2024, we've definitely seen a comeback. Where last year we had about 60 IPOs, and this year, despite the pause we experienced in April, we're on track so far for a similar number. So it's definitely been a comeback. I think there are three things I look at to assess how healthy the IPO market is. Number one is volume, and that picking up. Number two, which is even more interesting, is the quality of shareholders that buy IPOs. who's around those stories, who's deploying capital into new stories. And that has improved pretty meaningfully over the last 18 months.
Interesting.
A
And
lot
that's
of-
not something we can see. That's something
right.
that's easier for you to tell us about.
That's
Interesting.
right.
Okay.
So mutual funds, pension funds, large long-only, sovereign wealth funds, people with long duration of investment and a true fundamental analysis behind it are coming back to the market pretty aggressively. And the third thing I look at is what type of stories are we actually bringing to the market? In 2022, 2023, you saw a lot of more defensive stories, things that would work in virtually every market. What we're
Like kind
seeing,
of evergreen companies, not
That's right.
necessarily the big hypergrowth companies.
more
that
like
you associate
value,
with. Okay,
defensive,
interesting.
correct. The type of stories we're bringing to market those days is much more diverse. You see growth, you see hypergrowth, you see a variety of sectors, a variety of size. So that breadth of IPO stories shows me how much better the IPO market is today than it was 2 years ago.
Yeah, it seems like, just looking at the list of the biggest deals this year, the diversity is pretty interesting, right? The biggest U.S. IPO of the year is a natural gas company, right? Venture Global. Then you've got CoreWeave, which is a big AI story. SailPoint, a tech company. Circle, stablecoins. Chime, the neobank. eToro, which is like a retail trading platform. So, is there anything through those deals that you see that is thematic, that's representative of like what investors want, or like the kinds of companies that are ready to go?
I think there are probably a few sectors that are very topical today, and that's driving that level of issuance. Number one, you mentioned CoreWeave. I think anything that's AI or AI enabling is definitely being really well received by the market. That's number one. Number two, you mentioned tech. It's always been a big part of the IPO market, and we are seeing a resurgence of tech IPOs over the last 12 months. Fintech, health tech, so tech broadly defined. The third one that might surprise you, but that actually makes sense in this market, is aerospace and defense.
Oh, right.
You see the Voyager IPO, you see the Lore IPO, Standard Aero. So those names in the broadly defined aerospace and defense have come in size and have performed pretty well.
Is that because government spending is up? And of course, like I think, we've talked about this in previous episodes. In Europe, there's a sense that Europe has to sort of remilitarize, as the U.S. wants to spend less kind of defending other countries. Is that what drives that defense sector?
Yeah, there's government spending, and I also think there's a perception from investors that geopolitical risk is here to stay, and so I think that tends to favor A&D companies.
Okay.
But then the other question you had, which is what makes a good IPO candidate in this market? Away from sectors, I think there are a few attributes that investors are really looking for in this market. Number one is what I call durable growth. So we moved away from growth at all costs, hyper-growth companies, and now investors are more focused on companies that have the ability to deliver growth in a market that has a lot of volatility. So durable, resilient growth, that works really well.
I guess you wouldn't want to buy a company that relies on a certain kind of import that might have a completely different tariff level in 6 months than it does today. You want to make sure that you're buying into something that isn't vulnerable to that.
That's right. Something that is highly levered to one input of growth is a little bit less appealing to investors. That's something that has multiple levers to deliver on growth. So that's number one. Number two, investors like companies with a large addressable market, i.e. they have the ability to gain share over time and support their growth. And the third thing I would say is any company we bring to market that has a real competitive advantage versus their peers, either disrupting an industry or a unique way to approach a market, I think that's very differentiated. So whether you're durable growth, you have a large addressable market, and a real competitive edge, those three elements are very, very interesting to investors.
What would you say investors should be taking away from the kind of bounce back in activity that we've been having? What should that tell investors about what's going on in the markets and what's going on in corporate boardrooms?
Sure. I think it tells a few things. Number one, it shows that the ability for, and I'm talking about the U.S., companies to continue to offer exciting growth opportunities for investors is there. Number two, they should know that the way we execute those IPOs today is very different than 10 or 15 years ago. By the time an IPO goes public, there's been a lot of work behind the scenes before that. Discussion with investors, discussion with site visits. So by the time an IPO hits the market, they've been pretty de-risked. So I think that's a little bit of a change versus how we did IPOs.
They've heard everybody's criticisms and
they know
compliments.
valuation,
Like they kind of know where the
size.
market's going to be.
Correct. What they should know versus 2021 too is those IPOs today are really strongly backed by fundamental investors. People who have done a lot of work, met with the company, do deep fundamental analysis. And I think that's very healthy for the market. But I'm going to go back to your first point. Yes, the IPO market is very sentiment-driven, very momentum-driven. It's a high alpha type of product. So when there is a market that is skewed toward growth and investment, it tends to favor IPO for sure. When the market becomes more volatile or risk-adverse, the IPOs are the one that get a bit more challenging to execute. And you can see that earlier this quarter, right? We had high expectation that it would be a strong IPO year overall. And then when the market correction happened post-tariffs in April, I think a lot of those processes got put on pause. And then as the market came back, we saw this very interesting dynamic where issuers who had some plans to access the market, seeing how attractive valuations were, are very focused on not missing this window. So we see a number of issuers coming back to the market pretty aggressively. And on the flip side, investors who probably had missed a little bit of the V-shaped recovery we saw in May are very focused on deploying capital. So those two elements is what drives the current health of the IPO market.
And so let's dig into a little bit of how deals have performed, because there are a couple of things that I think are interesting about that. Number one is that the Journal recently reported that a number of companies that have gone public have done so at what in the business are known as down rounds, meaning that they were valued privately way up here, and then when they go public at a price that implies kind of a lower valuation than what they were valued privately. What do you think that tells us about the market? That companies are willing to do deals at those kind of lower public prices?
I think that's a reflection of the broader market. Some companies that have raised private capital at very, very elevated valuation during COVID I've come to realize that right now the valuation levels that it can achieve might be at a discount to this. I think companies are okay with this, assuming that they have real long-term investors behind it. What's important for a company when they go public is, yes, the valuation that is set at the IPO, but more importantly, are they attracting investors who are going to support them through the life cycle of the company? Are they going to be there when they need to raise additional capital? So that's important. Number two, yes, day one IPO price is important. More importantly, how does that perform 3 to 6 months down the road? And I think that's a better barometer for them of success than just looking at where they last raised capital and where they're raising capital today.
And how do companies feel about the pop, right? This is a phenomenon well known in IPOs where the company prices the IPO at one price, it jumps up to a higher price in the market after that. Sometimes it goes way above that, right? We've seen one deal recently, Circle, right? The stablecoin issuer. You know, their stock has just gone up since they sold it. It seems like not necessarily every day, but it's up pretty substantially. Is that a successful deal for companies that makes them want to keep coming back, even though in theory some would argue that they could have sold their stock for a higher price? How do you think that affects the market when you see some of these? Everybody's piling into these stocks after they go public. Is that good for the IPO market?
I think some good performance on the first day is important, and that's a good sign. Some outsized performance on day one, I think, is less of an indicator.
Yeah.
Once again, I think people want the good branding, and I understand it creates a lot of good media around the name, which is good. Once again, the sophisticated users of our markets and the issuers, they're more focused on where is it going in a couple of months. Who's behind and buying? Do I get some really strong mutual funds with conviction who have the ability to deploy capital over time? Those two are probably more important to them than the technical pop on day one.
So it's something that's happening a little bit behind the scenes of like who's participating in these deals that's really telling you that the market is healthy and not so much what we might see in the price action aftermarket.
That's right.
What about retail investors? I know that there have been a number of companies like Robinhood and others that have tried to offer investors access to IPOs. That is to buy into the IPO. Anybody can buy an IPO once it starts trading. But to get into that deal and to participate in that whole process, would you say that retail investors are playing a bigger role in the market now than they were a couple of years ago? About the same? I mean, historically, I think it's in the 5 to 10% range is typical sort of retail participation, small investors for an IPO. Is that kind of where it still is?
I think that's still the right ballpark.
Okay.
I would tell you retail is an important part of the success of an IPO for a lot of different reasons. At Morgan Stanley, we have the number one retail platform in the U.S., and I think that gives us a competitive edge. They tend to be big in IPOs, they tend to be early, and they tend to be active buyers in the aftermarket. And so I think those three elements make the retail pool of capital pretty helpful to IPOs, yes.
Now, another big part of the market is all these private companies, right? We talk a lot on this show, and in general in the journal about the number of companies that are staying private longer. Sometimes that's like a startup company that just sort of delays its IPO for a long time. But sometimes those are like big established companies that are owned by private equity funds. There's a lot of talk of exits. It's hard for those companies to get exits. We've written a lot about the challenge that private equity firms have had finding exits for those companies. One of the big exit pathways is IPOs. Does that tell us that there's a lot of pent-up demand for IPOs, or does it tell us that the IPO market isn't that sort of great of an exit path for a lot of these companies because maybe the public market isn't willing to pay what they think the company's worth? It just seems like that's a complicating part of the market these days.
Interesting. I have a slightly different take on it.
Okay.
I would say you're right. The private market has been very robust, especially over the last 2 to 3 years. It's flexible capital. You have a number of investors who invest in privates, of course, private equity, but sovereign wealth fund, pension fund, and some public dedicated investors who have set up some private funds. So there's a lot of demand.
Right.
It's flexible, and I think it allows companies to stay private for longer while accessing the market. I still think at the end of the day, a number of those companies will come public because the access to the public equity markets is really strong and very helpful. The acquisition currency, the branding. So I still think that IPOs is going to be the end result of many of those processes, but they're not mutually exclusive.
Interesting.
I think it just gives corporates more flexibility and option as they think about raising capital between private and public. And you'll see a number of the IPOs we're bringing to market have had several rounds of private capital raised pre-IPO. And I think on the sponsor side, on the private equity side, yes, they do have a number of assets that have become relatively large and that would definitely be ready for the IPO market. Private equity are very financially sophisticated investors. They realize that the IPO market is healthier, and so there's definitely a pickup in dialogue on that.
Another pathway to raising money, especially for private companies that's sort of come up recently, is this idea of like tokenized sort of stock offerings, right? Where a platform like a Robinhood or something might offer you a token that represents ownership in a private company. Do you think the tokenized offering a competitor to the IPO in the years ahead?
I don't think so. I think the same comment I would make about the private market and the public market not being mutually exclusive. I think if it's not the manner of sale for private companies, sure. I still think at the end of the day, after multiple rounds of private capital raise have been performed, the appeal of an IPO with the acquisition currency and the branding and the access to markets is still likely to be the same. So I don't think it's going to change the game meaningfully.
We're going to take a quick break, and when we come back, we've got one last question for Arnaud Blanchard of Morgan Stanley. So, Arnaud, again, global head of equity capital markets at Morgan Stanley, so you oversee the big global IPO business. So we've got one last question for you. In 30 seconds or less, what would it take for the IPO market to ever get back to those 2021 highs?
I think it's going to be pretty challenging for the IPO market to go back to the 2021 highs. I think the combination of very elevated valuation levels in equity, the very low interest rate environment, and the fact that people were deploying a lot of capital into equities in general made this euphoria of IPOs in 2021. So I think that's probably a high bar. But between where we are today and when we were, call it in 2018, 2019, pre-COVID, there's still some room to see a pickup in activity.
All right, so we've picked up, not quite at 2021, but maybe we'll never get back to that, or at least not for a long time.
That's right.
That doesn't mean that we can't still have
A very healthy market.
A pretty good market.
That's right.
In the meantime.
Mm-hmm.
All right, well, Arnaud, thanks so much for joining us. This has been great.
Thanks for having me. Am I supposed to hear your friend?
No, you're not.
Okay,
no.
great.
I was about to tell you that because sometimes you'll see me like kind of, and you might be wondering what's going on.
Understood.
That's just we talk about you privately.
Yeah, behind my back.
Exactly,
I love it.
Exactly.